This is Eat, Sleep, Invest, the marketing podcast for real estate investors to get more deals. Hey, welcome back, everyone, to another episode of Eat, Sleep, and Invest. I'm your host, Bryan Driscoll, and I'm here with Joe Viery. What's going on, Joe?
Hey, not too much, Bryan. Thanks.
Hey, I got your last name pronounced right?
You did. I'm amazed.
Yeah, nice.
Very good.
So I'm excited, especially this time of year, to talk about taxes. So, hey, Joe, why don't you give everybody a little background on what you do?
Okay, I started in 2007 in the cost segregation industry. I was working with the California Association of Realtors, and this again was 2007. So we all know what happened late 7 in 2008 when the car went off the cliff and fell over. And a guy kept asking me about this new thing. He wanted me to learn about it, and I kept blowing him off because I thought he wanted to talk to me about Amway soap. And finally, I gave up and I said, okay, let's go to lunch. He told me about this strategy where investors can reduce or minimize their taxes. I had two clients that had heavy tax burdens, like $50,000. So I basically said, sure, let me talk to my clients. And I talked to them and I got them involved in this. This was to me a new study. Then the car went off the cliff and the California Association of Realtors membership fell off and to zero. And the guy that owned the cost segregation company came back to me and said, you're really good at this. Why don't you segue into cost seg? And so that's what I've been doing since 2007. And I was fortunate because I had clients that had a lot of money and were buying, and they were not hurt by the recession, by the housing recession. So they were buying up property. So I was busy from day one, and I have never stopped. So about 6 years ago, I started my own company, and we've added a little bit of a new wrinkle where we can do single family homes or any type of buildings that have basis of 500,000 or less. We're one of the only ones that are a full service engineering company that provides this type of service for investors. We still do the detailed engineering study, which means we go out there and we measure everything, we document everything. The engineers do all of the calculations, with those properties, the detailed engineering. So basically, we can do any building from $50,000 building basis up to $500 million.
Yeah, and that's solid too, because I know you saved me a lot of money. I met you at Fuel, and you were telling me about this stuff. I'm like, okay. And I was able to do it on my properties and save some taxes last year, So tell everybody, let's get into it. Okay, cost segregation. A lot of people might not even know what that is. Why don't you give like the short version on that? And
you know what? Back in 2007, nobody knew what cost segregation was at all. Still today, a lot of people don't know what it is. It's complicated, yet I can give a very quick elevator speech on what it is. Basically, there's two methods to depreciate a building. One, a child can do, or maybe even a pet can do. All you do is you take whatever you bought the property, you deduct the land allocation, and you divide that, if it's residential, by 27 and a half years, or if it's commercial, it's 39 years, and you get a straight line, little bit of an expense for the next 27 and a half years, or 39 years. Well, it's a small expense. Now, why do investors want expenses? Because when you have gross income, all of your expenses reduce your gross income, which makes your taxable income a lot less. So expenses for anybody in the real estate market is good. You want as many expenses as possible. And for those involved in real estate, they understand this because real estate has a lot of expenses. They've got a lot of great tax advantages. So what we do, rather than taking that little bit for 27 and a half years, we reallocate the building components and we put those that qualify into shorter lives. For the inside of the building, it's 5-year property, which are things that everybody understands: window coverings, flooring, cabinets, specialty lighting. The outside of the building is 15-year property, and the 15-year property is everything including land improvements, fencing, landscaping, driveways, pools, patios, outside lighting. And then you're always going to have your real property, which is the main chassis of the building, which stays in 27 and a half year. Or 39 year. So you're always going to have the foundation, the walls, the doors, the windows, the roof. That stays in 27 and a half. So what we end up carving out is about 25 to 40% of the building basis we can peel off and accelerate. Now we have 100% bonus. So everything I find in tax year 2022, meaning the 5-year and the 15-year property, can be immediately deducted from your taxes in its entirety. So let's use a simple single family home example. $120,000 home, $20,000 we allocate to land, which leaves $100,000. If I find 25% of that, I will give the owner of the building a $25,000 tax deduction for tax year 2022, which is huge. $25,000 accelerated depreciation means the owner of the building is going to save in income taxes probably about $10,000.
Yeah, and that's huge too because so I'm 42 years old. I own rental properties. I don't want to do over 28 years because these are my high tax paying years right now. Versus in 20 years from now, taking those little percentages, it's like I'm in lower tax brackets. So it's nice I can take them all up front now, save on my income burning year or income years.
Yeah. And you know what? A lot of like accountants don't even get involved because they're not financial planners. They don't know the time value of money. So they just go, well, why would you bother doing this? You're going to pay a fee to do this when you're going to get the same amount, but you're just going to have to wait you have to wait 27 and a half years. It's a lot better if you get that big chunk and you save that money because hopefully the message to your investors is, I want you to buy more property. With the money you save, I want you to go out and buy more property, or I want you to improve your property. I want you to increase your wealth. And you do that by understanding the time value of money, taking the dollars today versus waiting 30 years.
Yeah. And the interesting thing is too, it's like, okay, you get the write off 10, 15 grand, whatever it is. But if you have multiple properties, you might be able to go from like a 35% tax bracket down to the lower bracket, which saves you even more money there.
Correct.
That's what I was talking with my CPA. He's like, we don't want to take too much. We don't want to get you too low in the IRS, but we want to get you to those lower brackets. So you get the write-off and the lower bracket, which saves on everything.
That's a good point. That's a really good point. And one of the ways, our philosophy is this. We like everybody to give us their whole portfolio of buildings. We will do the estimate and give you back what you can save on each property. And it's up to you to pick and choose. We're really busy. Thank the Lord that we're really busy, which means I don't care if you do one or you do multiples. You will save money if you do multiples because I'll give you a better deal on the fee. But bottom line is we don't care. I don't care if you do one or you do 10.
Now, question for you here. Say someone does 10 properties, which you might not be able to answer this because you're not a CPA, but if somebody does 10 properties and they say, okay, I only want to take 4 of them in year 2022, can they do the other ones the next year?
Yes. Yep. And we can go backwards too, which is something that was really unusual in tax law. We can go back about, and this is a financial calculation, we can go back about 15 years to do properties you bought up to 15 years ago. If it makes sense, then you would want to do it. So how does it make sense? We look at how much depreciation you've taken. We look at how much the fee is going to be. And then we look at how much accelerated depreciation you're going to get. And if it makes sense, and to me, making sense means this. Means if you could, I want everybody to get 10 times the fee. So if I charge somebody $500 for the fee, as an example, I want you to save $5,000 in taxes. End of story. If you don't save $5,000 in taxes, I'll be the first one to say, you probably don't want to do it. But it's up to the investor. I don't care what they do. So when we do a look back study, we do the calculations. And if it makes sense, I'll recommend you should probably do a look back study and take all of that new depreciation because you're going to come out ahead.
Yeah. And this is big too. Like anyone who has properties, reach out to Joe because it's kind of like found money here. I mean, you're getting the write-offs anyways over 28 years, but with what Joe does and then working with your CPA, it could be a big opportunity there.
And you hit the nail on the head as far as the 28 years. We don't give you any extra depreciation. A lot of times I had the first question early on was, oh, this must be a scam. This sounds like it's too good to be true. Well, we're giving you the same amount of depreciation. All we're doing is we're front loading it. That's the only difference. At the end of the day, at the end of the 28 years, you're going to get the same amount of depreciation, whether you accelerate it or you don't. So that, people understand that it's not really a scam because it makes sense. You're not scamming anybody. It's just the IRS recognizes. And the good example that I can give you is if you look down at your carpet and I tell you, is your carpet going to last 27 and a half years? It doesn't take a very brilliant person to look at the carpet and go, I'm lucky if it lasts me 5 years. What do you mean 27 and a half? So the IRS recognizes there are hundreds of components to the building that the tax courts have already decided that they are shorter life assets. So all we're doing is we're playing by the rules.
Yeah, I look at it, bird in the hand is better than two in the bush.
Yeah.
Like,
yeah, right. That's good.
I'd rather take, and everyone's situation is different too, but I'd rather, me personally, in my situation, I prefer to take it, but I'm a long buy and hold investor, which brings up a question. How about people that are buying short term?
Well, you know what? Here's the rule, and we're a little bit more liberal because I've been doing this for so long, and I've had wonderful CFOs for big corporations. And what we've come up with, our philosophy, our personal recommendation is as long as you're going to hold the property for at least 2 years, do it. If you're not going to hold the property for 2 years, if you're a flipper, I would say if you're a flipper, it's probably not going to pencil out. Well, why do I say this? Because there's a part of the tax law called depreciation recapture. And with depreciation recapture, what you're doing is you're going to pay back some of the depreciation you took when you sell the property. So if you're going to sell the property for cash only, remember, if you 1031 exchange, it's a moot point. If you die and give it to your heirs, it's a moot point. It's only when you sell for cash that you get charged this extra tax called depreciation recapture. However, one of the ideas behind cost seg, what a lot of people don't know, is that cost seg reduces your depreciation recapture. But let's go back to the 2-year advice I give. By the time you figure in what you're going to pay back and what I'm going to give you for the 2 years, unless your internal rate of return on the dollar I give you is super high, like 60, 70, 80%, I'll tell the investor, don't bother. Don't do it. Don't do cost seg.
So basically, this is more of a play of more buy and hold kind of stuff.
Yeah, it is.
Okay. Yeah, that makes sense too. How about being audited? Like, does it increase, like if you've seen, does it increase the likelihood of being audited?
No, those days have long gone. If your accountant doesn't know about cost seg, it has nothing to do with the legitimacy and it being recognized by the IRS. The IRS recognizes it's the way buildings need to be depreciated. Now, they're not happy about sharing this with people, but at the point, it's law, and they recognize it's law. So you will get audited for other reasons, and if you get audited for other reasons, they may want to ask a question about the cost seg they see that you did. And in that case, we defend all of our work to the IRS. So if the IRS calls your accountant or the building owner and says, look, I've got a couple questions, you call me, you get one of my staff on the phone, we'll answer all their questions. And I really kind of hate to say this, but it's the truth, is that since 2007, and I've done so many tens of thousands of studies, like I don't even know, it's such a vast number. But I've only been questioned once by the IRS. As soon as I answered the questions, they said, "Oh, we understand now. Thank you. Goodbye."
Better knock on wood.
It's just really, you're going to get audited for other reasons. You're not going to get audited for cost seg.
Knock on wood.
Well, now here's a caveat. The IRS is hiring, everybody knows this, like 100 million new agents. So I'm preparing, and we're really tightening up our studies because we are expecting to get questions from the IRS. We're expecting to answer them successfully, but make no mistakes about it. That this is now, we're coming into a new era, probably of more IRS audits. But I still that would be so low on my totem pole of making a decision that I wouldn't even worry about it. Just know that you need to go with a good company. You need to go with a company who uses the IRS's audit technique guidelines. That's what we base all of our work on. So we're legitimate. We don't mind being questioned by the IRS because we know we'll answer their questions.
Right. And if I understand this right, so basically you guys are going in, creating a report, pretty much itemizing the property, right?
Correct.
And showing which things that you can depreciate now, which things not. So it's an actual report. It's not like you're just saying, hey, I got a property that's 120,000, land's 20. We're picking a figure and going with it. So it's an actual study on the property.
Exactly. We provide everybody with, on the detailed engineering, our reports are 50, 60 pages. We break out everything. We break out the real property as well as the personal property and the land improvements. So you'll get a line item for countertops, for cabinets, for flooring, for window coverings, for electrical wiring, electrical outlets. We break everything down so that the complete building is dissected. When we do the analytical study, you're not getting that kind of detail because obviously we're not charging thousands of dollars, But bottom line is you're still getting categories broken down. You'll get like interior 5-year products broken down, like, not finite numbers, but like, just things like cabinets and countertops combined into one category that breaks it down. So the IRS can see how we did our analytics to back up our acceleration.
Yeah. Now, how's the process work? Like you're saying, if it's, I get if it's a big property, you may send people out or things like that. But these small ones, you're not sending somebody out to a property for $500. Like, is the property owner like giving you some information on, okay, here's what we have, or how's the process work whenever someone comes to you?
One of the favorite words by the accountants is it depends. So it depends on what's out there. For example, if you have a good appraisal, that's probably all we're going to need. Sometimes we will ask the building owner to give us some photographs of the interior of the building, because obviously we can look at the land by our satellite technology, but we can't look at the interior. So we may ask for a few photos, but you're not going to be surprised. Most building owners have photos of their properties. So it's usually not a big ask anyway. And we want the appraisal. We want any backup information like closing statements, plans. If you've got construction plans, which is pretty rare, so we're not holding our breath on those. But we don't need that much information from the building owner. And keep in mind that the difference between U.S. Tax Advisors Group and the others is we do all the work. It's not like you have to go online and fill out all this information, which takes sometimes hours. All we ask is a little bit of information up front. We compile the report. We include the audit defense in our fee. And so that makes us a little bit different than the other guys out there doing it.
Okay, and that's cool too, because I'm even thinking, like, I have multiple properties. That would suck filling out forms. But if I can just shoot over all the appraisals, I got them stored on my computer in one folder.
Yeah, I mean, I've had some like 100 properties, and I would say, look, if you're going to go with my competitor, that means somebody's going to have to spend minimum 100 hours. Is that really worth it to you? Over 2 weeks of somebody's time to input all this in, and you know how inputting is. You could make mistakes very easily, and drop a decimal point or add it. I mean, so after I explain that to him and say, no, you don't have to do any of that with us. We do all the work.
Okay, cool. Hey, Joe, another question for you, because I know it's getting close to the end of the year here. If somebody wants to do this for their 2022 taxes, do they need to have this done by December 31st or by the time they file their taxes in 2023?
Good question, Brian. So here's one great thing about December. Use this time for tax planning purposes. Meet with all your advisors on tax planning. However, you have to ask your accountant when we need the study. But we tell everybody, allow us 30 days before your tax deadline. Well, what's your tax deadline? If you're an on-time filer, for LLCs or LPs, if you're an entity owner, it's March 15th. So we want to have you in our system by February 15th. If you're not an entity owner, if you own it by, as a sole proprietorship, then it's April 15th, which means we want it by March 15th. And then if you're an extender, well, then the deadlines are September 15th and October 15th. So we have a lot of time. So don't worry about the time pressure, but don't get to us a week before and say, hey, I really need you. That is going to be tough.
Right. Yeah. Okay. That's what I was curious, because I'm like, it's so close to the end of the year. So that makes sense. So that's perfect.
Yeah. You have all January and February, basically middle of February, if you're an entity, to just get your act together. And we understand if somebody really needs it really quickly, we can turn it around a lot quicker than 30 days.
And it just a disclosure, I'm not a CPA. Joe's not a CPA. So talk to your CPA. Ask them the questions on that stuff. Energy studies. What are the new energy studies and tax credits?
Okay, what happened was these have been around forever. However, it was one hot mess. Every year, Congress had to extend the bill. Sometimes they wouldn't extend it for 8 to 10 months. So everybody was just going, okay, now what do we do? So we did some, but not very many. Well, with the new Inflation Tax Act, what happened was they changed the rules. So now it's got a 10-year window. It's been approved. And for those who own single family homes or multifamily, there is a tax credit called the 45L, energy tax credit. Well, what does that mean? That means going back for 3 years, if you have done an improvement to the energy efficiency of the building, you will get a minimum $2,000 tax credit, or you can get as much as $5,000, depending on when you have us do the study. What does that mean? I'll make it really simple. Here's the bottom line. There's a couple different areas. One is is the building envelope, doors, windows, insulation. Another one is the HVAC system. And then the other one is the electrical components of the building, the fixtures. So bottom line is, I will tell you this right now. If you have, in the last 3 years, replaced your HVAC, it is almost certain that you're going to qualify. Now, we're still going to have to do the testing, but the HVAC is such a big component that when somebody replaces the HVAC, most likely they're going to increase the energy efficiency over the thresholds that we test against. So if you just keep that in mind, if you haven't done the HVAC, we can still take a look at the building, but then we have to look at a lot more information to see, okay, what kind of insulation, what kind of light fixture did you put in, what kind of water heater did you put in? It's still possible, but then that, the easiest benchmark is if you've replaced the HVAC, take the tax credits, because tax credits are not depreciation. They are a tax credit. If I give you a $5,000 tax credit, you deduct the $5,000 from what you owe in taxes. It's not an expense. It's a deduction. So they're very valuable.
You said that, what was that? What was that? 54B or something?
45L.
45. I'm going to write that down.
45L.
Okay, cool.
Our phones are blowing up because everybody knows about this now, and the word's getting out that there's a new sheriff in town, 45L, and we are doing hundreds and hundreds of 45L because we know what we're doing, and the taxpayer can qualify.
Yeah, so you can depreciate it and you get a tax credit in addition.
Yeah, you can do the cost segregation and you can get the tax credit. So it's huge, huge.
Nice. All right, Joe, hey, if anybody wants to work with you or reach you, what's the best way to connect?
I think the website, www.ustagi.com, ustagi.com. And they'll go to the website and they'll get my phone number. They can schedule a meeting with me. I'm happy to talk to anybody about what we do. Very excited to talk to people about it. So just go to the website, ustagi.com.
All right, cool. Hey, Joe, what's your favorite book?
Think and Grow Rich.
Oh, boom. You knew that right off the cuff? That's a good one. I like that one.
I grew up on that book. I mean, long story, but man, that book made such an impact on me. I love that book, and I recommend it to anybody out there. If they haven't read it, read it.
True. It says what? If you think it and believe it, you can achieve it.
Yeah. Power of the mind.
That's right. Huge thing. All right, Joe. Hey, thanks for coming on, man. We appreciate you.
All right. We appreciate you. Thanks, Bryan.
Hey, thanks. Hey, and everyone, thanks for listening. If you have any questions, you can reach out to Joe. His website and everything will also be in the show notes. Thanks for listening. Until next time, get out there, crush it, and close some deals.